Welcome to this video on turning your savings into a smart, sustainable plan. First, we'll acknowledge your amazing progress in saving, and then address the problem. Inflation quietly erodes the value of idle cash. Next, we'll map out a practical path from savings to investing, with minimal stress and a clear framework. Finally, we'll wrap with an action checklist and quick quizzes to lock in your learning. Here's our roadmap. First, we'll cover why cash loses value. Then, we'll define the emergency fund and why it exists. After that, we'll discuss inflation and depreciating purchases like cars. Next, we'll introduce a time horizon framework and index funds. Then, we'll show how automation supports consistency before moving to a concrete action plan. Finally, we'll test your knowledge with 2 short quizzes and summarize key takeaways. Before we dive in, a quick disclaimer. This content is for education only and not personal financial advice. Your circumstances, goals, and risk tolerance are unique. Consider speaking with a licensed professional before making any financial decisions. Investing involves risk, including potential loss of principal. Diversification and a proper emergency fund are essential safeguards. Now that we've set expectations, let's state the problem clearly. You've saved a meaningful sum, well done. However, if that money sits in cash long-term, inflation reduces its purchasing power. Our goal is to transform idle savings into a plan that preserves safety for emergencies, while putting excess funds to work for long-term growth. First, let's explain why cash loses value. Inflation is the steady increase in prices that reduces what your money can buy. Cash appears stable because the number in your account doesn't move much, but its purchasing power declines. Conversely, investing in diversified markets exposes you to short-term volatility, yet historically offers higher long-term growth that can outpace inflation. This sets the stage for why we must separate emergency cash from growth capital. Next, we establish your emergency fund. Its purpose is safety, not profit. Aim for 3 to 6 months of basic living expenses: housing, utilities, food, transportation, insurance, and minimum debt payments. Keep this money in a high-yield savings account or comparable safe cash vehicle for immediate access without penalties. Consider adding a household or vehicle maintenance buffer if applicable. Review this fund annually as your expenses change. Remember, this cash is not meant to beat inflation. It exists to protect you from surprise expenses and job loss without selling investments during downturns. Quiz time. What is the primary purpose of an emergency fund? Option A, to earn high returns. Option B, safety and liquidity. Option C, to beat inflation. Option D, to buy market dips. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is safety and liquidity. An emergency fund's role is to provide immediate, penalty-free access during unexpected events. It is not intended to maximize returns or beat inflation. Moving on, if you've completed your emergency fund, leaving surplus cash idle virtually guarantees a loss in purchasing power due to inflation. Trying to time markets or buy commodities at price spikes is speculative and especially risky for beginners. Likewise, major depreciating purchases, such as brand new vehicles, can drain capital that could otherwise compound. If transportation is necessary, prioritize reliable and affordable options so more of your money remains available for growth. Let's compare 2 approaches. On the left is speculation. Chasing hot assets, buying during spikes, trading frequently, and making emotion-driven decisions. These behaviors increase risk and costs. On the right is a disciplined approach. Diversified index funds, a long-term focus, low fees that preserve returns, and automation that reduces emotional interference. Over time, the disciplined approach tends to be more repeatable and resilient. Next, choose risk based on time horizon. For money needed in 0 to 2 years, stay safe in cash or short-term instruments. For 3 to 5 years, use a conservative or balanced allocation to limit drawdowns. For 5 to 10 years, tilt more towards stocks for growth while maintaining diversification. For 10 years and beyond, an aggressive global equity core with a modest bond stabilizer is typically appropriate for long-term growth and volatility management. Aligning investments with your time horizon helps you avoid forced selling during downturns. This timeline illustrates the journey from cash to a working plan. In the first month, you calculate expenses and set an emergency fund target. In months 1 to 2, you open a high-yield savings account and begin funding the emergency cash. By months 2 to 3, you open brokerage or retirement accounts. From month 3 onward, you automate monthly contributions. Once a year, you rebalance and review goals to keep the plan aligned with your life. Now let's introduce index funds. Broad, low-cost ETFs deliver instant diversification by tracking entire markets rather than relying on single stocks. Lower expense ratios mean you keep more of your returns. To moderate volatility, pair your stock ETF exposure with a simple bond ETF. Most importantly, remain consistent through market cycles. Time in the market generally matters more than attempting to time market moves. Here's a practical action plan. First, calculate your basic monthly expenses and set a 3 to 6 month emergency fund target. Second, place that cash in a high-yield savings account. Third, define time horizons for each goal. Fourth, choose 1 to 3 diversified ETFs aligned with those horizons. Fifth, automate contributions on payday to remove emotion. Sixth, rebalance annually and keep an eye on fees. Seventh, avoid speculation and focus on consistent, rules-based investing. Here's an illustrative example for a $40,000 cash position. Assume basic expenses of roughly $2,500 per month. A 6-month emergency fund is $15,000, and we add a $2,000 maintenance buffer, totaling $17,000 in cash. The remaining $23,000 is invested, with about 80% or $18,400 in a broad equity ETF and 20% or $4,600 in a core bond ETF. This is not advice. Adjust based on your risk tolerance, time horizon, and goals. To make the allocation more tangible, this pie chart shows the split among emergency cash, stock investments, and bond investments. Visualizing the breakdown clarifies trade-offs and helps you stay committed to your plan. Always tailor these percentages to your goals, risk tolerance, and time horizon. Finally, let's talk about behavior. Dollar cost averaging smooths your entry price by buying more shares when markets fall and fewer when they rise. Automating transfers reduces decision fatigue and emotions that can derail your plan. Establish guardrails, a fixed contribution date, target percentages, and a scheduled rebalance. Track a few key metrics: your savings rate, total fees, and time in the market, to reinforce habits that drive results. Second quiz: what is the main benefit of dollar cost averaging? Option A: it perfectly times the market. Option B: it reduces emotion and smooths the impact of volatility. Option C: it guarantees higher returns. Option D: it avoids any losses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that dollar cost averaging reduces emotion and smooths the impact of volatility. It does not perfectly time the market, guarantee higher returns, or eliminate losses. Its strength is turning investing into a disciplined habit. Let's consolidate the essentials. Separate safety cash from growth capital. Keep 3 to 6 months of expenses in a high-yield savings account and invest the surplus according to a plan. Let your time horizon drive your risk level. Use low-cost diversified index funds, automate contributions, and rebalance on schedule. Avoid speculation and stay consistent. In summary, inflation quietly taxes idle cash, so we fortify safety first with a proper emergency fund. Then invest the surplus with a simple, long-term plan. Time horizon determines risk. Diversified index funds simplify execution, and automation builds consistency. Over decades, consistency generally beats attempts at timing. This framework turns fear into a repeatable plan. Thanks for watching. If this was useful, please like the video, share it with a friend who's sitting on too much cash, and subscribe for more practical guides. In the comments, tell us what step you're taking next with your savings and how you're setting up your emergency fund and investments.